Back in March 2023, something extraordinary happened behind the scenes in global finance. In the space of just a few days, the world's top central banks, the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank, and the Bank of Canada, put out a joint announcement that barely made headlines. What did they reveal? They were stepping up their long-standing US dollar liquidity swap lines by shifting from weekly to daily operations, and this enhancement was set to last at least through the end of April, with the facilities themselves remaining as permanent backstops. Picture this. These are the most influential money institutions on the planet, quietly establishing smoother, faster channels to swap massive amounts of currency whenever needed, with no strict caps mentioned. They framed it as a simple precautionary step to keep dollar funding flowing smoothly amid market uncertainty. But stop and think, when do central banks ever describe major upgrades like this as just in case, and then barely use them? Almost never. Actions like this don't happen by accident. They're signaling that something serious might be on the horizon, something big enough to require every major player to be perfectly aligned and ready to act at a moment's notice. And the clues about what that something could be? They're right there in the open, if you know where to look. Let me walk you through what these institutions have been quietly doing behind closed doors. Let's start with a massive gold accumulation that defies conventional logic. Across 2022 and 2023, central banks worldwide scooped up over 2,000 tons of physical gold, marking some of the strongest buying in more than half a century, with annual totals exceeding 1,000 tons each year. What's odd about this? During the exact same period, many of these same institutions were publicly insisting that inflation was temporary and their own currencies were rock solid. So why stockpile gold, the classic hedge against currency weakness and uncertainty, if everything is supposedly stable? Take the People's Bank of China. They reported adding hundreds of tons to their reserves. Poland ramped up by over 100 tons. Singapore, India, Turkey, and others joined the rush, snapping up physical bars and coins at a blistering pace. This isn't normal behavior for confident central banks. It's the kind of move you make when you're quietly bracing for turbulence ahead. And the trend only gets more telling from here. Next up, a mysterious new project from the Central Bank of Central Banks, the Bank for International Settlements, BIS. In mid-2023, the BIS rolled out concepts tied to its vision for tomorrow's financial system, often discussed in innovation reports around projects like future payment networks and resilient infrastructure. Think initiatives exploring seamless cross-border systems and backup mechanisms. Deep in their technical papers, you'll find language about systems designed to keep running smoothly even during major financial stress or when traditional infrastructure gets disrupted. In plain English, they're actively designing and testing fallback frameworks for the global financial plumbing. Why invest heavily in backups unless you anticipate the main system could face serious breakdowns? This isn't routine maintenance. It's forward-thinking preparation for scenarios where today's setup might not hold up. Finally, consider the ongoing crisis simulations. Since around 2020, and continuing strongly into 2023, the Federal Reserve, working with the U.S. Treasury and FDIC, has ramped up detailed resolution planning exercises. These are in-depth drills simulating how to handle the collapse of major banks. But they're not stopping at one or two isolated failures. The scenarios get intense. What happens when multiple systemically critical institutions face simultaneous severe pressure, triggered by a rapid collapse in market confidence? These aren't casual what-ifs. They're full-scale rehearsals for widespread banking stress, complete with coordinated responses across agencies. When central banks practice handling widespread chaos this seriously, it's not because they expect calm waters ahead. They're getting ready for rough seas, and making sure the lifeboats are ready. This pattern of quiet coordination isn't new, it's happened before, and the outcomes were disastrous. Go back to the summer of 1927. Heads of the world's major central banks, Benjamin Strong from the New York Federal Reserve, Montague Norman from the Bank of England, and representatives from France and Germany, met privately at the New York Federal. No official minutes, no press allowed. It was described at the time as a gathering of The world's most exclusive club. What were they up to? They agreed to ease monetary policy together, with the U.S. Federal Reserve cutting interest rates and injecting liquidity. The goal? To prop up the struggling British pound after Britain's return to the gold standard at an overvalued rate. The idea was to make U.S. money cheaper, drawing funds toward Europe and easing pressure on the pound. But the side effect? This coordinated easing flooded the U.S. with cheap credit, supercharging an already bubbling stock market and credit boom. Just 2 years later, in 1929, that bubble burst spectacularly, triggering the Wall Street crash and the Great Depression. The real lesson isn't just the bad call, it's how these powerful institutions work together in secret, assuring the public that everything was under control, while setting the stage for catastrophe. Jump ahead to the late 1960s for another chilling example. For years, mounting pressure on the US dollar under the Bretton Woods system led to dollars flooding overseas. Foreign central banks started redeeming them for gold at the fixed $35 per ounce, draining US reserves. To defend the system and keep the official gold price stable, 8 major central banks, led by the US and including Britain, Germany, France, and others, formed the London Gold Pool in 1961. They pooled resources and coordinated sales of gold into the London market whenever prices threatened to rise above $35, essentially suppressing the free market price through joint intervention. These operations were often discussed quietly at BIS meetings in Basel. Publicly, officials insisted the system was rock solid and the dollar-gold link unbreakable. Behind the scenes, they were burning through reserves to hold the line. What happened next? Speculative demand overwhelmed them. France pulled out, and by March 1968 the pool collapsed. The London market was forced to close temporarily, and a two-tier system emerged. Official gold stayed at $35 for central banks, but the private market price soared. Just a few years later, in 1971, Nixon ended dollar-gold convertibility entirely. Once again, secret coordination, public reassurance, and then a sudden, painful unraveling that eroded trust and purchasing power for millions. Now, the one that hits closest to home, and should make you sit up. In August 2007, as cracks appeared in the subprime mortgage market and liquidity dried up globally, the Federal Reserve introduced temporary currency swap lines with other central banks. These allowed foreign institutions to borrow dollars from their own central banks, which got them from the Fed, exactly the kind of mechanism that was quietly made more permanent in recent years. Behind closed doors, Fed transcripts, released much later, reveal officials discussing serious banking stress, liquidity shortages, and fears of contagion spreading. Yet publicly? On June 20, 2007, just weeks before the swap lines launched, Fed Chairman Ben Bernanke testified to Congress. We do not expect significant spillovers from the subprime market to the rest of the economy. 4 months later, they were rolling out emergency facilities. 14 months after that, Lehman Brothers failed, and the entire financial system teetered on the brink. The playbook repeats: quiet preparations and international coordination while downplaying risks to the public, followed by shock when things explode. So, history is clear: when central banks move in unison behind the scenes, building tools, rehearsing responses, and coordinating swaps, they're rarely just being cautious. They're bracing for trouble. Today feels eerily similar. What are they gearing up for in this cycle? The signs point to several major vulnerabilities they're addressing all at once. First, the massive U.S. Treasury market, $26 trillion and counting, is supposed to be the safest, most liquid corner of global finance. Everyone treats treasuries as risk-free. But we've seen it crack before. In March 2020, amid COVID panic, a desperate dash for cash hit. Investors sold even ultra-safe treasuries en masse to raise dollars, causing prices to swing wildly and liquidity to evaporate for days. The world's safest asset suddenly became hard to trade. The Fed had to step in with over $1 trillion in emergency purchases to stabilize things. It happened again in flashes, like during volatile periods in 2023, where routine Treasury auctions saw liquidity dry up, forcing quiet Fed support. Why the fragility? Huge amounts of treasuries need rolling over constantly, around trillions in the coming year. Traditional big buyers, like foreign governments, are pulling back. China has trimmed holdings significantly, Japan sells to support the yen, and others diversify away from dollars. Who's stepping in to absorb all this new debt when demand falters? That's the risk. Look at what the Fed has built in response. They've expanded the Standing Repo Facility, SRF, to provide unlimited, around-the-clock repo funding not just to banks, but to primary dealers and even money market funds. It's designed as a permanent backstop to keep the Treasury market functioning, no matter how bad things get. This isn't, if, the market strains again. It's preparation for, because when Treasuries falter, everything else follows. Next, vulnerability. The U.S. commercial real estate sector, valued at roughly $20 trillion overall, with trillions in loans tied to it. The big issue? A massive maturity wall is hitting right now. Hundreds of billions in CRE loans, estimates put around $936 to $957 billion maturing in 2025 alone, are coming due, with peaks even higher in coming years. Many of these were originated years ago when interest rates were ultra-low, 2 to 3%, and office buildings were packed at 90 to 95% occupancy. Fast forward to today, remote work has driven national office vacancy rates to record highs, around 20 to 20.7% in recent quarters, the worst since the global financial crisis. In major markets, properties have lost 30 to 40% or more of their value. Refinancing at today's 6 to 8% rates? It's brutal for owners, leading to rising delinquencies and distress. Why haven't we seen widespread bank failures yet? Regulators are letting many banks use extend and pretend tactics, pushing out maturities, keeping loans on books at old valuations instead of marking them to current, much lower, market prices. Studies show hundreds of regional banks could face serious trouble if values drop another 20%. The Fed's response? After the 2023 bank stresses, they rolled out the Bank Term Funding Program and similar tools, allowing banks to borrow against these assets at face value, no matter the market drop. It's a lifeline to keep zombie loans alive and prevent a cascade. This is classic extend and pretend on a massive scale. They're buying time, but the pressure is building. When that wall hits fully, it could ripple through regional banks and the broader economy. Then there's the rapid push towards central bank digital currencies, digital versions of fiat money issued directly by central banks. As of 2025, over 130 countries and jurisdictions, representing 98% of global GDP, are exploring, piloting, or launching CBDCs. Major players include China with its large-scale ECNY pilots, India expanding its digital rupee, and the ECB advancing toward a potential digital euro, now in preparation phase after studies and innovation tests. Even wholesale, bank-to-bank, projects like cross-border pilots are accelerating. Officially, the goals sound benign: faster payments, greater financial inclusion, reduced cash costs, and modernizing systems. But dig into the designs, and you see advanced features being built in: programmable money that can come with rules, like expiration dates, spend it by X date, or it vanishes, geographic limits, only usable in certain areas, or restrictions on what it can buy. Some concepts even allow negative interest rates, where holding cash digitally costs you over time. Why embed these controls? In past crises like 2008, rate cuts and QE didn't always spark spending. People hoarded cash out of fear. Next time, central banks might want tools for direct influence, force consumption, target stimulus precisely, or enforce behavior during stress. They're constructing the rails for unprecedented monetary control, not just efficiency, but the ability to steer money flows in ways traditional cash never allowed. The fourth big threat: exploding global debt levels that are becoming mathematically unsustainable. Total global debt sits just above 235% of world GDP in recent estimates, stabilized somewhat but still enormously high, with public debt driving much of the rise due to persistent deficits. In the U.S. alone, federal debt has climbed to around $38 trillion, growing rapidly. Interest payments alone hit nearly $1 trillion annually in FY 2025, about 19% of all federal revenue, outpacing defense or Medicare spending in some breakdowns. Here's the deadly math. At current rates, debt service eats a huge chunk of taxes. If rates climb to 6%, that share jumps toward 30%. At 8%, it could devour 40% or more. You're then borrowing just to pay interest on old borrowing, a classic debt death spiral. Options are grim. Let rates rise, governments default or slash spending. Print money to buy debt, inflation erodes currency value. Central banks are prepping the third path. Tools like yield curve control, already used by the Bank of Japan, where they cap bond rates by printing whatever it takes. It's effective for controlling rates short term, but it guarantees long-term currency debasement. They're leaning toward devaluing money over outright default, because the alternative risks systemic collapse. Finally, the slow erosion of the US dollar's unchallenged status as the world's reserve currency, something that's held since 1944. Today, the dollar still dominates, about 50 to 59% of global FX reserves, 85 to 90% of FX transactions, and most commodity trades, including oil. But cracks are appearing. De-dollarization efforts are gaining steam, especially in BRICS nations and beyond. China now settles a growing share of its cross-border trade in yuan, over 50% in some recent periods, up dramatically from near zero a decade ago. Russia, India, and others use local currencies for bilateral deals, including some energy trades. Saudi Arabia has shown openness to non-dollar oil sales, though progress is gradual, and BRICS discussions push alternative payment systems. The BIS has noted in reports that central banks should ready for a world with multiple reserve currencies coexisting, not one dominant player. When dollar dominance fades, the US loses its exorbitant privilege, the ability to print endlessly while others hold the dollars. That $38 trillion debt suddenly becomes harder to finance without exporting inflation globally. The infrastructure being built, permanent swap lines, CBDCs, emergency facilities, is all about managing a transition to a multipolar system while retaining as much control as possible. So why the silence? Why won't these powerful institutions just come out and say what's really on the horizon? The answer is brutally simple. Admitting the risks publicly would ignite the very fire they're trying to contain. Imagine the Fed openly warning, "We're deeply worried about potential Treasury market breakdowns." Investors would panic sell Treasuries overnight, creating the exact dysfunction they're preparing for. Or if they admitted, "Many commercial real estate loans are severely underwater," depositors would rush to pull funds from vulnerable regional banks, sparking runs and failures. And heaven forbid they say out loud, "Dollar dominance is fading, we're readying for a multipolar world." Foreign holders could dump treasuries en masse, crashing the dollar and spiking borrowing costs instantly. They're caught in a classic credibility trap. The entire system runs on trust and the illusion of stability. As long as everyone believes everything is fine, markets function smoothly. The second officials confess vulnerabilities, confidence evaporates, and the crisis accelerates. This is why every major meltdown follows the same script: quietly build defenses while reassuring the public, then coordinate responses when things crack, and finally act surprised. No one could have predicted this, as they deployed the tools they prepared in secret. Right now, we're firmly in the "everything is fine" phase. The moment that narrative shifts, it'll be game over for the unprepared. This predictable pattern has played out time and again. Phase 1: official calm and reassurance, while emergency infrastructure quietly gets built and tested behind the scenes. Phase 2: when cracks appear, the problem gets labeled isolated or contained, with international coordination kicking in to limit spread. Phase 3: full activation of those pre-built tools, followed by the classic line, "This was unforeseeable," as the system is saved. We're deep in Phase 1 today. The preparations are advanced, the rehearsals ongoing, the backups in place. When the shift happens, it'll move fast. When this unfolds, and history suggests it will, there will be unmistakable winners and losers. On the losing side, anyone heavily exposed to fiat currencies like the dollar, euro, pound, or yen, especially those holding large amounts of cash, bonds, or fixed income assets. Central banks may devalue these to manage exploding debt, eroding purchasing power through what they'll call necessary inflation. Pension funds, retirees on fixed incomes, and middle-class workers whose wages never quite catch up. They'll feel the squeeze hardest, slowly getting poorer without fully understanding why. Smaller regional banks and their depositors could face pain too, as regulators prioritize system stability over bailouts for every institution. The winners? Those positioned in hard assets that thrive when paper currencies weaken, physical real estate, especially productive or in-demand types, commodities, gold and precious metals, or ownership in resilient businesses. People who accumulate monetary metals or inflation-resistant holdings ahead of the official acknowledgement. They'll come out ahead. The ultra-wealthy, with access to top advice, diversified global assets, and hedging strategies, will navigate devaluation smoothly. But here's the empowering truth: you don't need to be ultra-rich to end up on the winning side. Knowledge is the real edge. Understand the signals now, while they're still downplaying everything, and position yourself accordingly. History rewards those who see the pattern early. Central banks are clearly gearing up for major disruptions they can't openly discuss, because doing so would trigger them. They won't spell it out, but their actions scream the message: record gold buys, permanent liquidity lines, crisis simulations, backup systems, digital currency controls, and infrastructure for managing debt and currency transitions. All while the public narrative stays. Everything is stable. The crisis isn't a question of if, when, and how prepared you are. History's harsh lesson? Trusting official stories during secret preparations rarely ends well for everyday people. Don't wait for permission or headlines admitting the risks. That's when it'll be too late. The smart move is now, while they're still saying, all clear. Educate yourself, diversify into real assets, reduce exposure to vulnerable debt, and build resilience. Because when the reassurances stop, the real game begins, and the prepared will thrive. What side will you be on? The choice is yours starting today.